thank you, Julie, and to the American Horse Council for having me today. I do plan to cover everything, our accounting and tax topics at a high level and focus on general concepts. So if you do have questions, I've put my contact information along with some of my colleagues at the end of the slideshow presentation. So please feel free to reach out either via chat or a follow-up email. I'm certainly happy to follow up with you. So just a general reminder as we get started today. Um, I am covering general information. It shouldn't be construed as tax or legal advice. Please talk to your tax advisor before doing anything. Again, the idea is just to introduce concepts or reminders today. And we are going to be focused on for-profit businesses versus nonprofits. As far as the agenda, what I plan to cover, uh, we're going to start out kind of, beginning through operations and then looking at the sales piece. So how to structure, from common structures that we see in equestrian and farming operations, some accounting basics, what happens when you purchase assets, what federal tax incentives are available as you operate, and some decisions that are available when you sell or donate horses, sort of at the tail end. And then we'll wrap up with some discussion of tax limitations and a brief mention of state tax items. So that's what we plan to cover today. And then Julie, after I finish that, she'll cover sort of the report from Washington, what we can, and that should be an interesting report based on current activities there. So that's what we plan to cover today. So let's just get into it and start talking about the common entity structures that we see for horse and farms. The simplest is a sole proprietor. That's a single individual. It's one person you report directly on an individual tax return. Again, it's very basic. That what I would say is in this situation, you want to make sure that you have separate bank accounts for your horse and farm activities. And you want to look at, from a liability protection perspective, do you have insurance to reduce your exposure to liability in the sole proprietorship? Co-ownerships are also very commonly used in the equestrian world, and it's a little bit less formal than a partnership. And essentially, we see this quite a bit in the equine industry. But again, it's less formal than a partnership, which typically has a partnership agreement. There are two types of partnerships. There's a general, which is unlimited liability, and then there's limited, which limits the liability of the partners. So partnerships are very flexible. They allow specific or special allocations. So if you have partners who are putting in debt in addition to cash contributions, you may be able to specifically allocate losses that are funded by debt to partners. And so partnerships are commonly used by horse and farm owners. And then S corporations are also still a flow-through type entity. So these first four, sole proprietor, co-ownerships, partnerships, and S corporations, all are flow through, and they may file their own company tax returns or be reported directly on the individual's return. The activity flows through to the ultimate owner. S corporations are the same. It is a flow through. They are less flexible than partnerships, but they do limit exposure to self-employment tax. So typically we see S corporations being used by service providers. So trainers, bloodstock agents, those that really don't have a ton of appreciated assets that are in the sort of hard assets that are in the entity. So if you try to withdraw an appreciated asset from an S corporation, it is difficult to do that without paying income tax versus a partnership, which you can typically do that. So again, there's a lot less flexibility with S corporations. While it limits your exposure to self-employment tax, you are technically required to use to pay yourself a reasonable salary as well to get some employment tax paid in. So again, we see some S corporations, but typically we wouldn't see an S corporation own a farm or own horses, that type of thing. Um, uh, I've talked about flow through entities, and again, those are the most common for horse owners because that way it's just um, one layer of tax. Conversely, C corporations are used by some owners. The C corporation does not flow through; it pays its own level of tax, its own. But it also files its own federal and state tax returns. So, for federal purposes, it's a 21% income tax rate. But oftentimes, if you're trying to pull money or pull cash out of the C corporation, there'll be another layer of tax. If there's earnings and profits in that C corporation, it would be taxed to the recipient as a dividend.
You sent it in the WhatsApp group. You could forward it to yourself if you want to pull it up on your computer.
I think if you all could mute, that would be great. It's coming through, I think. So just be great if everyone could mute and just send any questions in the chat. So on the C corporation side, typically most US owners do not use C corporations because of the potential for double tax, even though there's a 21% tax rate, but there could be a separate dividend tax rate when the cash is withdrawn. Where we most commonly see it is for non-US owners this way the non-US owner is not filing a US tax return. And then also for those large ownership groups that may have hundreds or thousands of shareholders, by filing as a C corporation, each individual shareholder then is not required to file. It all flows through the C corporation. So those are getting to be a little bit more, we see a little bit more of those with some of the micro shares and the large ownership groups. But for the most part, most industry owners focus on the flow through entities, the first four at the top. And then limited liability companies, most really structure through limited liability companies, and they may be any of the above. So you could have a limited liability company that's a single member LLC, or so that goes directly on an individual's return. An LLC taxes a partnership, an S corp, a C corp. So the LLCs kind of take on whatever ownership or structure of the above, and they are quite commonly used. The other thing I'll mention that we're not really focusing on today is just nonprofit entities, and where we see this across the industry is as social clubs. So some of the racing clubs are set up as social clubs, as nonprofit entities, or membership organizations. Alternatively, you may also donate to a 501c3, which makes grants to qualified recipients such as riders. The big downside of doing that is that you could give up control. That the 501c3, the nonprofit entity, has the right to decide how to use those funds that you contribute. So I just mentioned that because we're seeing a bit more of that in the industry as well. But when you're looking at how you structure your farm operations, there's not only, I primarily covered the income tax pieces, but there's also some legal tax pieces as well that you should consider. Some accounting basics for the industry. Most in the farming industry qualify to use the cash basis method of accounting. It can be used if gross receipts are less than or equal to 30 million for 2024. You basically receive a tax deduction for expenses when paid, including stud fees. And this really accelerates the deductions for income tax purposes. So for an example, if I have a no guarantee stud fee contract that I purchased in December of 2024 to breed to a stallion in 2025, that stud fee is deductible in 2024, even though it will not produce a foal until 2026. And that related income opportunity for that 2026 foal may begin either in 2026 if the foal is sold as a weanling, in 2027 if the foal is sold as a yearling, or 2028 when the foal begins racing as a 2-year-old. So again, that illustrates the acceleration of deductions. And there should be a non-tax reason if there's any prepayment of expenses for example, if you're prepaying a stud fee, because you get access to a particular stallion, or there's a discount that's offered by the farm, that would be considered a non-tax reason for any prepayments. You're still required to capitalize the purchase of any assets. and related expenses, so including sales tax and commission. So if you buy a horse, that still gets capitalized and depreciated versus currently expensed. And if you don't qualify to use the cash method of accounting, then you're required to capitalize not only the purchase price, but all pre-productive expenses. So that would include stud fee and related care until the horse is placed in service. And I'll talk a little bit about what placed in service means here shortly. But again, most that we see qualify for the cash method of accounting. So I'll talk a little bit about federal accelerated depreciation, which is very impactful for the industry. So in general, you're required to capitalize and depreciate versus currently expense the cost of assets purchased. So depreciation is merely the methodology used to write off the cost of the purchase asset over time. So instead of writing off 100%, you write it off over a period of time. And there are federal depreciation tables in the IRS publication that are used based on the life of an asset. And so there's 3-year life assets, there's 5-year, 7-year, 10, 15, 20, et cetera, 27 and a half, et cetera. That all is in the IRS publication. However, bonus depreciation accelerates the timing of when and how much can be written off of a particular asset purchase for federal income tax purposes. So so we have bonus depreciation, which the Tax Cuts and Jobs Act that was passed in late 2017 significantly expanded not only the percentage, but the property that qualified for that. And so right now, for 2024, we have 60% bonus depreciation that's available. And so what that means is that on qualifying assets, you can claim 60% of the purchase price, and on the remaining 40%, you claim regular depreciation. So the 60% for calendar year 2024 equates to about 65 to 73% of total depreciation in year one. And then now currently in 2025, we have 40%, which equates to about 48 to 60% in year one, depending on the year and when it's placed in service, the life and when it's placed in service. And Julia will give us a little bit of insight as to what we think might happen, which is a big if at this point in 2025, but that's what we currently have now. So again, it doesn't increase the amount of deduction available. It just accelerates the ability to write off a greater portion of the purchase price sooner for a particular asset. In order to claim the bonus depreciation, the asset must be purchased and also placed in service. So for racing prospects, that's either when the horse begins racing training or breaking in the fall of the yearling year, or when the horse begins racing as a 2-year-old. For sport horses, it's when the horse begins training or when the horse begins competing. And then breeding stock, it's when the horse is available for breeding. So if I buy a barren mare at the end of during 2024, because she's available to be bred, that would qualify as being placed in service, even though we would never breed her in the Northern Hemisphere time at the end of the year, because we obviously don't want the foal. We want the foal being born at the correct time. So we do look at when the horse is available for breeding, not necessarily when the horse has been bred. And so any of these are acceptable methodologies to follow, but you should be consistent once you have a policy. So if I decide I'm going to place yearlings in service the fall of their yearling year when they begin breaking and training, I should be consistent in that versus on an annual basis deciding whether to place yearlings or whether to place racing prospects in service as yearlings or as 2-year-olds. So again, the consistency is key there. Most horses do qualify now for bonus depreciation, and this was a big change when the Tax Cuts and Jobs Act was passed. It used to be that if a horse was previously used by an unrelated person, it didn't qualify for bonus. Now it does. And so again, that opened up a large, the large dollar purchases for well pedigreed fillies who had been successful on the racetracks that were mares. So breeding stocks, stallion prospects typically qualify. So again, most horses do qualify for bonus. I've really listed the exceptions here of what's not available for bonus, and that's horses that are previously owned, Now, I will say we see a lot of situations where you may own 50% of the horse and then you buy the other 50%. We've taken the position, and I think it's a valid one, that if I never owned that other 50%, that's a new purchase, and that would qualify. Horses used predominantly outside of the US. Again, this is supposed to be a US economic incentive, so that sort of makes sense. And the predominant use is a number of days test. So you look at it from the time you purchase that horse to the time for like to the total number of days after purchase in that taxable year to determine if you meet the predominant use test. If you purchase horses from related parties or receive via inheritance or gift, those are not eligible for bonus. Horses not eligible to be currently placed in service, like weanlings. They're, until they're ready to be placed in service, they're not eligible for depreciation. And then horses that are inventory and not placed in service. So if you're pinhooking horses, those are typically not treated as depreciable property, so they would not qualify for bonus in general. Other common assets that may qualify, equipment, fencing, land improvements like roads and underground utilities, and barns. And we do find that it's very helpful on farm purchases. So we often work with those who are buying farms to, if we can get ahead of it, get a very detailed appraisal that includes an allocation to things like fencing and roads and underground utilities. And maybe even put it as in the purchase agreement as an allocation, as an agreed upon allocation. If that doesn't, if that's not agreeable to the seller, then oftentimes we'll get a cost segregation to allocate to those specific depreciable assets. But the good news is that you can take a significant, typically a good part of that farm purchase and carve out the depreciable items, not just the ones that are here, but also to residential, to if you've got on-farm housing for your workers, that's not eligible for bonus, but that's a depreciable item that can be carved out as well for depreciation purposes. So a lot of times we do look at that to see how we can carve out the depreciable piece of that total farm purchase to help reduce taxes a little bit. Another alternative that's different from bonus depreciation is called Section 179 expensing, again, for federal purposes. States have it as well, but there may be reduced numbers. So for 2024, the annual limit on the expensing is increased to 1.22 million on up to 3.05 million of purchases. After you exceed that amount, then it reduces dollar for dollar until it goes away. It's limited to net taxable income, and so it's less impactful to many horse owners for this reason. So unlike bonus depreciation, which may be used to create or increase a tax loss, 179 is limited to taxable income. So we do see folks that use it, but only if they have taxable income. And it continues to only be available to active trades or businesses, which we'll talk about in a little bit, versus passive endeavors. So this is, again, I think bonus. We've seen it has a larger impact, I think, to the greater industry versus 179. But where 179 has come into play is on some of the profitable entities. As the bonus depreciation percentage has decreased from 100%, and now we were at 60% in 2024, now we're at 40%. If you have a net profit, the 179 expensing is very beneficial because it allows you to reduce your purchases potentially dollar for dollar, versus only 40 or 60% plus or minus for 2024 and 2025. And just a comment about depreciation decisions. So if you are a partner in a partnership, there's a lot of racing syndicates out there, and you want to maximize your deduction for tax purposes. It's really typically not up to you. If it's coming through a partnership, the managing member or the managing partner makes that decision, and it would be applicable for all partners in that partnership. Whereas if the horses are owned via co-ownership, then each co-owner makes their own individual decision about depreciation. So just a little difference there on who makes that decision. Of course, if you're operating, as a single member LLC, then you make that decision yourself. There's no need to decide for with others. So just a little comment there about that. We'll talk briefly about some federal tax incentives that are available for horse and farm operations. So the first one being the 25% QBI, or qualified business income deduction. It is, this was intended to close the gap between that 21% corporate income tax rate and the 37% top individual rate. This is available for non-C corporate tax owners. It's calculated at the owner, partner, or S corporation shareholder level. And if you get K-1s from these flow-through entities, they'll provide you with the information to add this to your return. And it's generally 20% of qualified business income from all businesses and there's certain limitations, of course, but it cannot exceed 20% of taxable income, excluding net capital gains. So it would be applicable for your horse activities, but also your other business activities as well. So I'm a numbers person, so let's just take a brief look, a couple examples here. So we've got an individual filing a joint return that has taxable income of $250,000, no capital gains. They have a boarding and breeding business that generates $300,000 of ordinary net income. The deduction is the lesser of 20% of taxable income, which is $50,000, or the 20% of qualified business income, which is $60,000. So in this case, we look at the 20% of taxable income, and the deduction is $50,000. Same taxable income as the prior example, but you've got $300,000 net income from a boarding breeding operation, but the horse racing activity generates a net loss of $200,000. So again, the deduction is lesser of 20% of taxable income, which is still the $50,000, or 20% of the qualified business income calculated for each business, which is the $60,000 minus $40,000, or $20,000. So in this case, the deduction is $20,000. This has been a pretty impactful deduction for profitable operations. It also is applicable to REIT dividends. So we've seen that be very beneficial for many that own the REIT dividends too. This was I think I mentioned this, I left this in. I think we fixed most of these for industry participants, and some the guaranteed payment, basically having access to a guaranteed payment outweighs the potential deduction. But guaranteed payments from a partnership are excluded from this qualified business income. So to get this 20% deduction, so we've recommended to several people to rework partnership agreements to replace guaranteed payments with special allocation of income items. And that which again has the potential to increase this qualified business income deduction for partners. I think technically, if you want to do this for 2024, you have until next Monday to do so. I think you have it until the original due date of the federal tax return without extension. So if you don't get it for 2024 or haven't gotten it already, perhaps it's something to think about for 2025. And again, sometimes it's not possible. If people would prefer to have that guaranteed dollar amount, then it's, they may not want to do that. But just a note there. There's some limitations that may apply if 2024 taxable income exceeds the thresholds listed on the slide here. Basically 192,000 if you're single, or 384,000 if you file a joint tax return. And then you look at, there's a wage limitation or a wages and depreciable assets limitation. And then specified services businesses may also not be eligible. There's also some very complex aggregation rules that are beyond the scope of today's presentation, but I've done some articles about them as far as if you can aggregate or do you want to aggregate and what that means. So just ping me if you're interested in them. I'm happy to send those articles to you. The other, another item that we see, we do use quite frequently, and I think it's missed in certain returns if you're not familiar with this, but it's farm income averaging, and it's an election to determine the current year's tax liability by averaging the net income from farming in the current year over the 3 prior years. So, and farming includes the breeding, selling, racing horses, raising, feeding, caring for, training, and managing animals. So it includes it includes the equine business. And what this really is intended to do is if you have a big horse sale, or if you're using your farm in your horse operations and you sell the farm and generate a big gain, this looks over the 3-year period prior to this and averages your income tax rate. And we've been able to get, people to a 6 or 7% federal tax rate by using this average over based on their activity for the prior 3 years. But again, it's intended to protect farmers from the wide swing in farming income. And it wouldn't apply if there's a net farming loss. This only applies, and only is applicable if there's farming income. So I will say it's not, for those that use tax prep software, this is not automatically calculated. You do need to do some work to get to the number, although the tax software is getting better at calculating this, but we do sort of do a manual comparison to make sure that we're maximizing it. But again, I just caution that it's not something that the tax prep software would automatically do for you. You've got to take a look at it. Another operating tax federal incentive that's available to farmers is a fuel tax credit. And so federal excise tax paid on certain fuels can be claimed as a credit. And generally it's available for full fuel used on a farm for farming purposes or used in an off-highway business use. And the credit is 0.183 cents per gallon. And so we do have some that claim this credit, and it's impactful. It is a dollar for dollar credit. But we also say, you do have to track the amount of gallons and the related use. So I always say weigh the value of the credit versus the administrative burden of tracking that. Okay, so let's talk a little bit about, we kind of talked about the depreciation, what happens when you purchase assets, some of the incentives that are available as you operate. Let's talk about when a horse is sold. What happens there? What should you look out for? So horses that are held for more than 24 months may qualify for long-term capital gain treatment if they're sold at a gain, or at ordinary loss treatment if they're sold at a loss. And so that's for business horses. And of course, exceptions apply primarily to pin-hooked horses, which are treated as inventory, and so they're always ordinary. But again, instead of a typical long-term holding period is 12 months, for business horses and cattle, it's 24 months in order to qualify for long-term. And then horse activities group with other business assets on an individual return. So if you have your horse activity that generates a overall capital gain, but you have some other business assets that generate an overall capital or overall loss, those would be combined on your individual return to see if they end up being a net capital gain or an ordinary business loss. There's some planning involved there as it relates to that. Another thing to think about when you're doing a sale and you don't receive all the proceeds in the year of sale is the installment sale election. And so you might be able to at least recognize all or a portion of the gain in a future year when the cash is received. I will caution that the portion of the gain from the depreciation recapture is includable in the year of sale. Doesn't matter if the cash is received or not. So for an example, if I have a $100,000 horse that's fully depreciated and I sell it for $500,000, so the total gain is $500,000 because I've taken $100,000 of depreciation. So the net basis in that horse is zero. So I have a $500,000 gain. If the proceeds are received in a subsequent year, I can either claim the full gain of $500,000 in the year of sale, or I can elect on a form 6252 to only include the $100,000 in the year of sale and the remaining $400,000 when received in a subsequent year. So again, that's not required. You don't have to make that election, but it potentially is available. And there are some special rules about what qualifies for this installment sale election too, and what the agreement needs to say. Not necessarily that you just received the proceeds in a subsequent year. Another deferral mechanism is what's called an involuntary conversion. And so if you receive insurance proceeds due to a horse dying from disease or injury, or when other property is destroyed, stolen, or condemned, you may be able to defer that gain. And you make this election by attaching a statement to the income tax return in which any part of the gain is recognized. The proceeds must be reinvested in similar use property within 2 years after the tax year in which any part of the gain would have been realized. That's a mouthful. So, let's walk through an example here. If we have a homebred filly that dies in December of 2024, if we receive insurance, so it's a zero tax basis, we have insurance proceeds of $100,000 that were received in January 2025. I have until December 31st of 2027 to reinvest into another horse or group of horses. And then the purchase price of those horses would be reduced by that $100,000. There's not a specific requirement to have a same-sex horse, filly for filly, colt for colt, but we would typically recommend it has to be similar or related in use. So, racehorse for racehorse, breeding stock for breeding stock, mare for mare, stallion for stallion. So, again, this is an area where you don't have to do this. This is available to you. But the other thing is to take a look and see, consider, does it make sense to currently include the gain? Does the horse qualify? Would this qualify for capital gain treatment? And maybe it's at a lower income tax rate than if it's an ordinary sale, which would be at your regular income tax rates. And so this isn't, this is something available to you if you get insurance proceeds on, horse related death. And it's available, you can use it, but you don't necessarily have to use it either. On the flip side, many consider donating horses, and that's that's wonderful. What I do want to say there is that there's lots of limitations that apply from an income tax perspective that may reduce or eliminate any income tax benefit. So it's important to be aware of, when you're looking at, do I donate? Do I sell the horse and then donate the proceeds? How do I do that? But you may receive a charitable donation or deduction for the fair market value of the horse that's donated to the charity, a 501c3 charity. It must be unconditional. So you must not, retain conditions. And then proper documentation must be maintained. So substantiation documents and a qualified appraiser or qualified appraisal by a qualified appraiser, the fair market value of the horse is required if the fair market value exceeds 5,000. We typically see this for people that donate horses to riding programs, or programs that would use these horses in their riding program. It must be, if you're getting a fair market value deduction, it must be reduced by the amount of gain on the sale that would be ordinary income if the horse was sold at fair value. So basically, the charitable deduction for horses held as inventory or pinhooked horses or owned 24 months or less is limited to tax basis. So if I have a homebred that meets this criteria, then my charitable deduction is zero. The charitable deduction for horses owned more than 24 months on which depreciation has been claimed is reduced by the amount of depreciation claimed. So these are just little, again, I'm just mentioning these to you guys as part of your consideration for when you're looking at, do we donate horses? And if the charity does not use the horse to further its charitable purpose, so like, let's say you give a horse to the United Way, they're going to turn around and sell the horse, then you're limited to the tax basis in the horse from a charitable deduction standpoint. So we always say consider look at alternatives for which the horse, which maybe more income tax efficient. You could look at selling the horse and donating the proceeds versus donating the horse. However, obviously, considering what is best for the horse is the priority. And I just merely want to point out that you should discuss with your tax advisors before you decide what you want to do, so that you know what the income tax impact is of whatever decision that you make. Okay, so we talked about the good stuff. Now let's talk a little bit about the limitations, and I'll sort of run through these a little bit quickly, but just wanted to make you aware. So the Tax Cuts and Jobs Act started this new concept of excess business losses, and it limits business losses that are currently deductible by non-corporate income taxpayers, so individuals, trusts, and estates, against non-business income. So the net tax losses from businesses in excess of 250,000 for individuals or 500,000 for joint filers, which are adjusted for inflation, are on an annual basis, are disallowed, are currently disallowed. So for 2024, the amounts are 305,000 for individuals and 610,000 for joint filers. And that excess loss is currently disallowed. It becomes a net operating loss that's eligible to offset up to 80% of income in future years. So for an example, in 2024, if I have $1 million of investment income and $1 million business loss, and I'm married and file a joint return, I can offset I can take the 610,000 of business loss, my limitation in 2024, against the $1 million of investment income. But I'll have a $390,000 carry forward that becomes an NOL that I'll be able to use to offset up to 80% of all income in future years. This excess loss provision it currently expires for tax years beginning after 12/31 of 28. And for many industry participants, it typically is a 1-year deferral of the excess business loss because they can use it to offset other income that's non-business. Now on the hobby law side, I do spend quite a bit of time in IRS controversy work. Most agents, if you're picked for audit, most industry participants will have to take a look at this and analyze it. It's sort of a heads I win, tails you lose scenario for the IRS. Through calendar year 2025, the expenses associated with the hobby are no longer deductible. So if you generate $100,000 of revenues from your horse activities, you would not be able to offset those with any of your expenses, which is extremely detrimental. So this, looking at a business versus hobby distinction is very important. And so it really it eliminates any of the things we talked about from a depreciation perspective, and those all go away. So it's very important if you are trying to operate like a business that you're looking at the hobby loss rules and what you can be doing to operate your business or your horse operations with the intent to make a profit. The IRS regulations list 9 factors for determining whether or not an activity is conducted with the intent to make a profit. No single factor is determinative. However, what we see is most impactful is factor 1, the running it in a business-like manner. So good books and records, tracking on a per horse basis if possible, looking at what's working for your horse operations, evaluating over time if there are changes to be made, identifying what's not working, and addressing how you will change to try to make a profit. I typically recommend that on an annual basis, you do at least at a minimum, do a short summary of what went well, what needs to change, and what you're continuing to evaluate, and then just some key operating activities that you did for the year. So that way it's in case this comes up again. There is a presumption that's for horse and farm operations. That's a 2 out of 7 year presumption. So what this means, it just shifts the burden of proof. So if I meet this test, then the IRS has the burden to prove that I'm a hobby and not a business. And it is very difficult to do for many horse and farm owners. And so what I would say is that for most, the flip is not true. So it doesn't shift. It doesn't, I'm not automatically deemed a hobby if I don't meet the 2 out of 7 rule. But what I do have to do is, if the IRS audits and they raise the hobby issue, then I have to go through the 9 factors, and I have the burden to prove that I'm a business and not a hobby. So again, that's something that's helpful if you have it, but not the end of the world if you don't. On the flip side, the passive activity rules are applicable to businesses only. So it's really a timing of the deduction. Hobby, you permanently lose the deductions. Passive activity rules, it really just impacts when you can claim the loss. And so if you're deemed a passive activity, the losses may offset other passive income or carry forward until the activity is disposed of. Regulations list 7 tests for determining whether an owner actively participates, but most horse and farm owners qualify, or we evaluate your level participation under the 500-hour test. And contemporaneous records are not required, but we recommend them because it's a little difficult to remember what you did. I have a hard time remember what I did last week, much less a couple of years ago. And there's specific qualifying time that may count. That your activities that are directly related to your horse operations. So going to the sales, going to the competitions, going to the racetrack, attending conferences, those should all count. And there's a lot of varying activities that would count too. But tracking your time and what you're doing is very important here from a passive activity perspective. One last mention, and then I'll turn it over to Julie to give the discussion from Washington. But I've primarily focused today on the federal piece and federal incentives and federal guidelines for tax reporting, but each state differs. And so you'll have different incomes tax rules by state. And then there's also some differing sales and use tax rules by state. So, many states do not recognize the federal bonus depreciation that I discussed today, for example. So it's important to take a look at the states. And then also on the sales tax side, each state has different exemptions, rates, et cetera. So those exemptions could be based on the use of the horse. For example, many states have breeding exemptions or a breed registry in certain states. And so it's important to take a look at that. I will say that Dean Dorton does have an equine sales and use map on our website that you can go to and click on and get some information about the various states from a sales and use tax perspective. But again, this was intended to highlight some key items from a federal perspective, accounting and tax wise. I've included my contact information up here along with my colleague Joe, who leads our equine tax practice, and feel free to email or reach out to either one of us. With that said, I'm going to turn it over to Julie to talk about the report from Washington.
Thanks, Jen. And for all of those that are listening today, so many of the topics that Jen has covered are frequent questions we get at the American Horse Council. Someone has a horse, they want to donate it to a charity. How does that all work? Questions about hobby loss. They are often looking for expertise to help when they are fighting with the IRS over hobby loss or other factors. So reach out to Jen and Joe. They're great resources, or feel free to contact us at the American Horse Council. We'll be happy to put you in touch with someone. Now, as we said in our promotion of this webinar, we invited a congressional staff member to brief us on proposed tax initiatives. And unfortunately, they were not available, but they did send us some talking points. So I'm going to cover those with you. We were very pleased to hear from Representative Andy Barr of Kentucky. His office has been instrumental in a couple of tax initiatives. The first one is the Racehorse Cost Recovery Act, which he introduced. This legislation makes permanent the modification of the accelerated depreciation allowance for racehorses to allow a 3-year recovery period for any racehorse. Currently, that default, as Jen stated, is 7 years, but realistically, the useful life of a racehorse is 3 years. And so they want to make that match a permanent law. This encourages investment in racehorses, and in this dynamic industry, we feel this is vital. And so we're very pleased to see that this is moving along. I'm going to talk about progress here in a minute. Second one he introduced was the Racehorse Tax Parity Act. This legislation shortens the holding period for racehorses to be considered eligible for long-term capital gains treatment from 24 months to 12 months. He said we need to level the playing field on that asset class and make it a 12-month holding period in order to get that capital gain treatment. So that's number two. And third, a return to 100% bonus depreciation. What might be the most important thing to the equine industry, he said for Kentucky, I'm going to say for the whole industry, is to return to 100% bonus depreciation, also known as immediate expensing. This provision is vital to the horse industry, not only for trainers and owners, but breeders, farms, and small businesses, many of whom would not be able to participate if this wasn't for the bonus depreciation incentive. He stated this is very important for the equine industry because most horse purchases qualify along with items like farm and office equipment, barns, roads, fencing, and farming vehicles. The 2017 Tax Cuts and Jobs Act significantly changed the rules for bonus depreciation by allowing businesses to immediately write off 100% of the cost of eligible property acquired and placed into service before September the 27th of 2017 and before January 1 of 2023. Prior passage of that Tax Cuts and Jobs Act, bonus depreciation was 50%. The 100% write-off expired at the end of 2022 and has decreased by 20 points each year ever since. And he said, we currently sit at a 40% write-off for eligible property in 2025, which Jen alluded to. So as we look at a tax passage to extend the major priorities of the Tax Cuts and Jobs Act, Representative Barr is going to be fighting for the return of 100% bonus depreciation and the inclusion of his 2 equine tax provisions to spur our industry forward. So we're very grateful for all the work he's doing on this. Now, Jack did supply us with a little status update, and as Jen alluded to, things are a little complicated. I'm going to use that word loosely in Washington. They've got a lot of priorities on their plate. So some things are moving, some things are moving slowly, some things are not really making a whole lot of traction. But here's the update. He said, Chairman Jason Smith, who Representative Barr had the privilege of talking to this past week to help advocate for these specific tax bills, wants this to move, and he wants it to move fast. He is focusing on advancing this legislation, and his goal is to keep advantage of the current momentum and have something on the president's desk to sign by Memorial Day. So write that on your calendar. Memorial Day is his target. We passed the budget resolution last week, which is a great first step, but is only the first step in a long process of passing a reconciliation bill. So although the Ways and Means Committee is still writing the bill, it will primarily be focused on extending the Trump tax cuts from 2017, which includes bonus depreciation, nearly doubling the standard deduction, R&D expensing, and doubling the child tax credit, as well as lowering 5 of the 7 individual tax bracket rates. So that's your update from Washington on specific equine tax issues that are out there. We want to open the floor for questions. So if you have a question, raise your hand or throw your question in the chat. We'll be happy to address those. And I will say there's a lot of information that was presented today. And this was recorded, and these slides will be made available to you if you want to go back and look at the material, ponder on that, and think ahead about what some of these impacts might be. So anybody with a question out there you want to throw to either Jen or I, we'd be happy to try to help you address those or find answers to get back to you with. Let's see, here's a couple of questions coming in. Will the downsizing of the IRS impact the average taxpayer? My answer is yes. Jen, what's your answer?
Well, I've seen it from different sides. So, I mean, yeah, it's certainly going to. I mean, we've had beginning in, I would say, July of 2020, we've had increased high net worth audits. So we've been quite involved. A lot of horse owners have been involved in those high net worth audits. And so, and then they got, the IRS did receive that increased funding, and there's been some priority projects in past years. So certainly with the decrease in staff, there should be less, I would assume less audits, less scrutiny. The one thing that we are seeing is that a lot of the people who have been in the IRS for a number of years on the appeals side, and sort of the executive offices have, they're retiring. And so we're losing a lot of that good historical appeals knowledge. And on the appeal side, we're dealing with agents who are used to being IRS agents, and that's a very different role than the independent office of appeals. So it'll be interesting to see what happens over the next few months, but certainly I do envision that there'll be significant differences.
And I'll just add, whether we're dealing with the Internal Revenue Service or the U.S. Department of Agriculture or the Department of Interior, whatever those federal agencies might be, we really have a very limited number of equine knowledgeable experts in those departments. And so if we lose some of that knowledge and that expertise, as she alluded to, that really complicates matters even more so for all of us.
Yeah, it is very difficult to find people within the IRS that have an equine specific expertise, for sure.
Yep. Okay, our next question is, when does a newborn foal become taxable?
It really doesn't become I don't know what the question is. A newborn foal is just, typically it's a result of a stud fee being paid, or and so it's not a taxable event. I don't know if maybe that question can be rephrased so I can understand the
Okay, we'll see if
question.
our listener wants to clarify. Maybe we can.
Yeah, that would be good.
Okay, anybody else got a question out there? Now, Jen, you and I were talking before we started recording that some of these states that have been affected by these terrible storms, floods, fires, they've got some different timelines that they're working on for filing their tax returns. So you want to tell the listeners a little bit about what those are?
Sure, yeah. So the IRS has issued disaster relief for things like the floods in North Carolina last year, and then for also the California wildfires that occurred in early January this year, and then the floods in Kentucky in mid-February. So you can actually go to the IRS website. If you type in IRS disaster relief by state, it's very comprehensive, very good. So things like the California wildfires that that extended everything that was due after early January through October the 15th, I believe. And then same with for LA, then that would be for LA County. That was a county specific disaster relief. The flooding in Kentucky, the IRS actually extended that disaster relief for anything that was due after, I think, February 14th through November the 3rd. And that's for the entire state of Kentucky. So that also can apply to those that have businesses within those, so don't necessarily reside. It's going to be an automatic relief if you file a return with using an address within the impacted areas, or the areas that are under this disaster relief. But if you're not, if you don't file and you're not automatically impacted, but you have a business in those areas, you can call the IRS and get registered for that relief. So it is impactful from a cash flow perspective. And looking at that, and then there is that farmer deadline that would normally be on March the 3rd. That is extended now in those particular areas too, because we have some, we have those extensions available, and that would have been after those deadlines. So again, and the IRS just came out with a notification about that the other day. So just certainly look at, to see what's available. We are still trying to, plow through and get through returns, business as usual, but we were primarily using it as a cash flow planning tool to help individuals.
Okay, so we've got time for one more question and then we'll wrap up. Someone posted here, justifying value of a homebred sport horse foal out of Olympic bloodlines, but not started in training.
And I don't know what I guess, is it like to contribute to a partnership? I mean, there is no, from a value, if it's a homebred sport horse foal and you're continuing to own it, there is no tax basis. So there's not a value that's put on that when you're depreciating it. However, if you are using that to, like, let's say you're contributing that homebred sport horse foal into an LLC, into a partnership, and you're getting credit for that value, then that's just really the agreed upon value that you and your fellow owners would agree upon when you're contributing that. But your taxable depreciation for the person that owns that homebred does not change. If you continue to own that homebred, it'll have a zero tax basis. It only will change if to give you credit for making a contribution into a partnership.
Yeah, so the follow-up was, so what you're basically saying is a foal is not taxable until sold.
That's correct. That's correct.
All right. Okay, good. Well, we're going to wrap up here. Thank you again, Jen. This is very helpful as always. I will say a hot topic right now that we are hearing at the American Horse Council is about tariffs and how tariffs are being imposed. Jen and I were talking about it beforehand because we're all still seeking some guidance and some clarification. For example, if you are transporting a horse in or out of the US to Canada or Mexico for competition and you're only temporarily staying, it's our understanding there's not a tariff imposed there. But if you are selling a horse going in or out, tariffs would be imposed there when tariffs are going to be imposed. We just don't know when, exactly how that's all going to work. So follow the American Horse Council, go to our website. We've put out some good content about some of the implications of tariffs that we're a little concerned about. And we are working with other coalitions to try to figure out how to identify some carve outs or some clarifications about tariffs for our industry. So if you want to learn more about the American Horse Council, go to www.horsecouncil.org and check out all the things we do. We also publish a monthly podcast, which you can follow on Horses in the Morning Radio Network. Do some really fascinating interviews there, so check that out. We will be scheduling our second quarter webinar in the next few weeks. And if you have a topic you'd like for us to consider, by all means, reach out and be happy to talk to you about possible subject matter experts that we could get to speak on those topics. So with that, thank you for spending a little of your Monday with us, and we wish you a wonderful week. Thanks, Jen, and thanks, everyone.
Thank you.